Inflation is when prices rise, and the money in your pocket doesn't stretch as far as it used to. A little bit of inflation is healthy for an economy, but too much can be damaging. Inflation can make it easier for some households with higher wages to pay off debts, but it can also erode purchasing power for both consumers and businesses. Inflation is a problem for the global economy because it can reduce economic growth and create uncertainty. When inflation is high and unpredictable, people may postpone spending and investing, which can lower demand and productivity. High inflation can also make exports less competitive and increase the cost of imports, which can affect trade balances and exchange rates. Inflation is especially a problem for the poor and vulnerable people because they have less income and savings to cope with rising prices. They may also face higher interest rates on loans and mortgages, which can increase their debt burden. Inflation can also reduce the real value of social benefits and pensions, which can worsen poverty and inequality. Inflation can also affect access to basic goods and services such as food, health care, and education, which can have long-term consequences for human development. Inflation is a general increase in the prices of goods and services over time. It reduces the purchasing power of money and erodes the value of savings. Inflation can have various causes, but some of the main ones are supply chain disruptions. The COVID-19 pandemic has disrupted the production and distribution of many goods, especially those that rely on global trade. This has created shortages and bottlenecks that have pushed up the prices of raw materials, intermediate goods, and final products. For example, the global shortage of semiconductors has affected the production of cars, computers, smartphones, and other electronics. Energy and food price shocks. The prices of oil and gas have surged in the global market due to a combination of factors, such as rising demand, lower supply, geopolitical tensions, and environmental regulations. Higher energy prices increase the cost of transportation, heating, electricity, and other inputs for many industries and households. They also affect the prices of food, which depend on energy-intensive inputs such as fertilizers, pesticides, irrigation, and refrigeration. Demand pressures from fiscal stimulus. The unprecedented fiscal stimulus measures implemented by many governments to support their economies during the pandemic have boosted the aggregate demand for goods and services. This has created a situation where demand exceeds supply in many sectors, leading to higher prices. The stimulus has also increased the money supply and the public debt, which can have inflationary effects in the long run.